Hey everyone, it's Imran back with another macro options spotlight. Okay, markets rolling over quite a bit yesterday on the back of weaker JOLTS data, showing some cracks potentially in the labour market, renewed banking stress as KRE closed down 6%. Now that thing just really struggled, it just couldn't bounce, and now all of a sudden these stocks are now cratering again after First Republic got taken out by JP Morgan, but other banks now coming under pressure, particularly some of these West Coast banks with large CRE books that people are concerned about. Europe and China also selling off aggressively, coming back from May Day bank holidays. In commodities, we're seeing a bit of bifurcation. Precious metals responding well to the drop in real yields. So they rallied with silver up 2% and gold. Miners were up double that, gold miners that is. And then the industrial commodities suffering, oil down the worst, 5%, nat gas down 4%, copper and uranium also down a couple of percent apiece. Oil really breaking down there below some technical supports, looking pretty ugly. Looking at vols, decent pop in vol. You can see here around 2 vols or more across the board in equities. We've been seeing vol pretty soft. We were looking for some mean reversion to the upside, just needed a bit of a trigger for it, and we got one. Although VIX did touch near 20, but did fade again back off those highs as S&P got back above 4,100. We'll see. We've got Apple earnings. Obviously, we've got FOMC tonight, and we've got non-farms on Friday. So plenty of potential for volatility this week. Commodity vols also popping pretty hard, up again a couple of points, 2 to 3 points. Only copper really lagging there, which was pretty flat, but a nice bid coming back there for vol just in general. Looking at carry, that hasn't changed too much, although it's just reduced a bit. So we were in very deep green. That's reducing somewhat as Europe's kind of reminded us that it can move, putting in 1.5 sigma type moves there. And then the carry pretty much where it was in US indices. Looking over at commodities, we did see oil flip into negative carry, everything else still in green. On skew, we did see a nice pop in skew, back to kind of the 60th percentile in S&P there. Clearly, a market got a bit spooked in what's going on in the banks, so that naturally feeds its way into hedging flows. And given the liquidity resides in the S&P, that tends to catch a bit of a bid. Put premium, though, has now been juiced up going into FOMC. If whatever Powell says or does can manage to, not disappoint the market, then just by virtue of vol drifting a bit back down, now that there is actually some stress, but it's not really the FOMC that's stressing the market out, it's the banks. So I'm not sure that FOMC is going to bring us any relief in terms of vol, because that's not the thing that's driving the vol. We'll see. Sometimes the market does look for words of comfort from Powell, and if he gives some, and if there's any kind of dovish slant in anything he says, maybe the market's going to latch onto that, and we see skew and vol soften a bit, and that will fuel a bit of a Vanna rally. So there is the potential there now, which wasn't really there at all before that move yesterday. So that is something to watch out for. And then we are seeing a bit of a bid come back to upside in precious metals, seeing that skew turn negative or more negative again, whereas we're seeing the opposite in energy with the likes of oil, nat gas, uranium, all finding a bid for puts. Okay, looking at the charts. So yesterday it was all about this, the thing that triggered the moves initially was this JOLTS data, missing expectations, showing signs that the labour market may not be as strong as what we're seeing in terms of the non-farm payroll data, but we have got that coming out on Friday. Bonds obviously catching a strong bid, along with the regional bank stress, First Republic and all that being consumed by JP Morgan. That kind of triggered that, and it continued throughout the day. One of the main reasons that the Fed has been able to stay so tight on rates has been the tighter labour market, and seeing this data roll over, if it does get confirmed by non-farms on Friday, would certainly give them the justification for a pause. So, the one and done that the market is pricing for may well get confirmed by the end of this week. Yields obviously had popped on the previous day. Janet Yellen bringing forward D-Day for the debt ceiling to the 1st of June. But yesterday's safe haven bid reversed all of that, and we're kind of back to where we were. The move index is obviously rising here, putting in a little bit of a bottom here and turning up. The VIX not really turning up materially yet, but we did see an intraday pop, biggest pop we've seen in a while. So lots of room for the VIX to kind of catch up there. Okay, and then what are we looking at ideas wise? We're just reviewing some of the trade that we've already got on. So looking at yields, they do look vulnerable now to another leg down. So clearly the 2-year yield had that huge move in March, 150 basis points in like a matter of days. That was a record move, but then it's been ranging. So that's the green line, been kind of ranging for the last 6 weeks. And then the latest move in KRE has taken KRE down 10% in that last leg down. And to new lows. So we do think this might kind of drag yields lower with it. Certainly I have seen that initial reaction, but we think there's some room potentially to go here as the Fed will come under more pressure for the pause and or pivot. Fed fund futures right now are pricing in an 87.5% chance that they hike today. And there's a tiny percent chance they actually cut as soon as June. So we have seen that flip into very small probability of cut in June, which we hadn't seen for a few weeks now. Okay, we think longer dated SOFR futures have also got room to rally to price in a higher probability of a recession, because this is becoming more and more inevitability, we think. At the start of the year, we got into some SOFR trades. It was the call spread that we had on, a digital call spread, as it's called, when it's a very tight call spread where the strikes are close to each other. All right, that's it for today's. Thanks for listening.